the profile of our first speaker, Mr. M.D. Mallya, I found that he took the reins of Bank of Baroda as chairman and managing director when the entire world was amidst recession. And Mr. Mallya, rather than getting bogged down, took it as an opportunity. And do you know what he did? Well, he doubled the business of his bank in 3 years with an annual growth rate of over 30%. In recognition of his inspiring leadership and innovative strategic thinking, Mr. Mallya was awarded twice with Banker of the Year award by Business Standard and also recognized with the same award by Business World in 2011. He has also been awarded Best CEO, Public Sector 2012 by Forbes India.
Good morning, ladies and gentlemen. It's my honor and pleasure to speak to you today in this international conference on global economy at crossroads, hopes and challenges, organized by Bahrain chapter of the Institute of Chartered Accountants of India, affiliated to the Bahrain Accountants Association. Let me thank the organizers for giving me this opportunity to address this august gathering. The central theme of this conference is very important, given the increased uncertainty in the global economic environment. Let me start by quoting Christine Lagarde, Managing Director of IMF, who had recently said that, I quote, 5 years ago, the global economy avoided a second Great Depression. 5 years on, the journey is not yet complete, but the fog of crisis is lifting. And we can see that its aftermath leaves us with multiple new transitions, I unquote. While emerging market economies like India have proven resilient to the past turbulence, they have now become highly vulnerable to a slowdown in mature markets and face increasing risks both from the trade and the investment channels. Let me therefore begin with the global macro backdrop. You may be all aware that the global growth continues to be sluggish, as reflected in the downward revisions in projections by various international agencies. For instance, on the 8th of October 2013, IMF lowered its forecast of global economic growth to 2.9% in 2013 and 3.6% in 2014, down by 0.3% and 0.2% respectively from its forecast in July 2013. Notwithstanding a distinct improvement in growth in the advanced economies like the US and some parts of the Eurozone like Germany and France, and also in the countries like the UK and Japan, new risks to global recovery have arisen from fiscal discord in the US and uncertainties arising from expectations related to withdrawal from unconventional monetary easing by advanced economies. The 5 emerging market economies, to my mind, that are likely to be highly sensitive to this tapering are Turkey, Brazil, India, Indonesia, and South Africa. On the positive side, the global inflation remains benign with slack in labor markets, expected stability in commodity prices on the back of improved capacities, and receding geopolitical risks from countries like Syria and Egypt. Global financial markets got a breather with the Fed decision around mid-September 2013 to maintain the pace of its bond purchases and its signal that the withdrawal of the quantitative easing may take longer. The US unemployment rate in August 2013 was 7.3%, still at the high end of the 7.1 to 7.3% band, which was expected by the end of the year. The US economy is certainly struggling with this target. In addition, the US GDP forecast for 2013 had been lowered to 2 to 2.3% from 2.3 to 2.6% announced earlier this year. These economic data convinced members of the FOMC to await more evidence that progress will be sustained before adjusting the pace of its purchases. However, we must remember that this is a temporary relief and there is a possibility that financial markets could be disrupted again when the extraordinary monetary accommodation in the advanced economies is withdrawn. Given this backdrop, let me now turn to the emerging economic environment in India. India, in fact, had witnessed a very high growth of above 9% during the 3-year period from 2005-06 to 2007-08. However, its growth slowed down to a modest 6.7% in 2008-09. That was the year of the global financial crisis. Thanks to a coordinated fiscal and monetary measures proactively undertaken by the RBI, that's the regulator in India, and India's government, the nation's economic growth recovered to almost about 8.5% in the subsequent 2 years. Despite this, similar to other emerging market economies, India's growth momentum now has slackened to almost around 5% or less than that on account of global uncertainties which have been growing, as well as a plethora of domestic structural problems. According to the Institute of International Finance, Washington, the weakening of growth in emerging market conditions is not just cyclical, but also reflects underlying structural factors, including a lack of reform during years of impressive performance and a gradual exhaustion of the drivers of rapid growth. During the current financial year, that is FY 2014, the only positives for India are good monsoon rains and improved agricultural prospects, a good pickup in exporting industries on the back of currency correction, and Indian government's dedicated focus to clear stalled projects from the infrastructure space from the beginning of the current financial year. As per the latest notification, the Indian government has cleared 113 projects worth about rupees 3,708 billion from the infrastructure segment until early November 2013. Some reflection of this is actually seen in the improved print for India's core sectors, basically the infrastructure output growth at 8% in September 2013. However, inflation continues to remain a major macro risk for India, caused by sticky prices of food and fuel, Indian rupee depreciation. In fact, the Indian rupee depreciated by almost about 15.3% during April-September 13 alone, and government's increased spending in rural areas. From the global side, uncertainties surrounding the tapering, though have subsided for now, the concerns regarding the accentuated spillover effects continue to pose new challenges. Against this backdrop, let us try to examine what are the major challenges for the Indian banking industry. So let me try to analyze one after another. To start with, I would say at this point in time, the biggest challenge and the crisis faced by the Indian banking industry could be that good credit demand has not been sound. We don't have too many credit proposals coming in for approvals. Investment decisions are not being made by the corporates, and therefore the demand for good credit has been very, very sluggish in the recent past. There could be many reasons for this. One of the reasons I would say is the major stress point in terms of the stress experienced by the existing corporates in terms of the asset quality as far as the banking system is concerned. There are many reasons for the companies not doing too well. The infrastructural shortages, especially power, could be one main reason. Delays in getting clearances, high input price inflation, forex volatility, non-payment or delayed payment are dues by the government agencies, and demand contraction. Therefore, all these factors put together have put a tremendous strain in terms of the output by the various corporates, and therefore significant stress as far as the asset quality is concerned in the Indian banking system. In fact, according to the Indian rating agency CRISIL, larger firms with operating income of over rupees 10 billion are more severely impacted by indebtedness and high cost of financing. Moreover, stretched working capital cycles are aggravating liquidity pressures on the companies. The second important factor could be that the inflation continues to reign quite very high. The CPI-led inflation have put a tremendous strain in terms of the ability and the capability of the Indian banking system to raise resources at reasonable cost. Because for banks in India, raising deposits at reasonable cost is a very important factor in ensuring that the intermediation is reasonably low priced. Therefore, the inflation remaining high, the cost of deposit with the banking system can mobilize in the current context is high, and therefore the interest rates reigning as far as the lending is concerned continue to be very high. That being the case, as far as the major corporates or other lenders are concerned, it is a very significant impact in terms of the interest cost these corporates are required to bear now. So therefore, this has put a tremendous strain. It's a vicious circle in terms of the bank's net interest margin under pressure, the interest cost borne by the lender, the borrowers being higher, and therefore, all in all, the continued stress in terms of the performance of the corporates in the Indian context continues to be difficult. Therefore, this could only be overcome, in fact, if the inflation comes down, demand picks up, credit lending rates come down, and therefore, the borrowers are able to access the credit market and able to get finance at reasonably cheaper rates than what it is today. For the banks, what has happened is that the cost of funds being very high and the availability of funds not being too high, they have to resort to borrowing at higher cost, again putting a lot of stress both in terms of net interest margin and also in terms of their propensity to lend larger to the Indian system. Therefore, all in all, the liability franchise as far as the Indian banking system is concerned is under tremendous pressure during the recent past. Look back 2009-10, even after the Lehman crisis in 2008, August, September, India was still able to navigate reasonably well in terms of its growth. Even though the growth had come down during that year, perhaps 2009-10, India could surge strongly ahead as far as the growth is concerned, despite the fact that the global overall economy was facing crisis in terms of the recession faced all across. We saw quite a number of banks running under pressure, quite a number of banks being closed in the US. Almost per day, a bank was getting closed. To look at the numbers, I think more than about 170, 180 banks were closed within a period of 3-4 months post-Lehman crisis. But then the Indian banking system was quite resilient. As I mentioned earlier, perhaps there was a coordinated effort between the regulator and the government, between the fiscal and the monetary policies, on account of which there was a sort of a sustained equilibrium, sort of a proper navigation as far as the whole thing was concerned. And therefore, despite what was happening in the overall world economy, Indian economy stood well, the Indian financial system continued to be well, the Indian banks continue to do well. But then today, again, we have come to a situation where, because of the inflation-led economy, I think we are finding it difficult to really achieve the growth rates which earlier India was to consistently achieve, maybe right through the period of the decade 2001 onwards, but then currently we are lagging behind substantially in terms of that. Let me go ahead. Third important factor, or the third important challenge, is that the gradual economic recovery of the US, which we have been seeing, and the strengthening of the dollar, which are putting a lot of pressure on the Indian rupee. downside bias as far as the Indian rupee is concerned, and at the same time the bond yields we see a upside price. These create tremendous amount of challenges as far as the bank's treasury operations are concerned, a major component of non-interest income for the banking system in India. You have a lot of mark-to-market requirements to be met because the bond yields keep on increasing in the recent past. At the same time, the forex volatility, which we have seen in terms of rupee depreciating very substantially, has put added pressure. Therefore, whatever could be the reason which has resulted in this particular phenomena, the treasury income, which used to be one of the main factors as far as the overall non-interest fee-based income of the banks is concerned, has been under tremendous pressure in the recent past. Therefore, look at all the factors which I'm talking about from the banker's perspective in India. You don't have a credit demand because the investment decisions are not being taken strongly in the Indian context, because everybody is seeing a wait and watch policy as to when exactly the economic cycle, which is seeing a downturn now, could see a reverse. So there is no credit demand, difficult to raise resources. If you raise resources, it costs you high, therefore the pressures on the net interest margin. The fee-based margin, fee-based income is also under pressure. Anyway you look at it, there is no credit growth or a small credit growth. NIMs under pressure, and therefore the net interest income is low. Added to that, the treasury income or the so-called fee-based income from the other activities has drastically come down. Inflation remains high, the resources mobilization is difficult. Therefore, it has become a sort of a vicious circle from where I think, to my mind, the only way to come out is to see that the drivers of growth are put back to place. Again, if you look back 2008-9, 2019, I think one of the most important factors in the Indian context, if the growth was achieved, was the fact that the investment decision in terms of infrastructure projects, primarily the power and the road projects, there was a very significant surge in terms of fresh investments being made. That has been totally now gone away because of many factors which I narrated earlier. Therefore, unless these drivers of growth come back, unless investment decisions are made as far as these sectors are concerned, it could be difficult in the current context to surge substantially up. I'll come back to that a little later. But then what are the offshoots of these developments? When these developments of these phenomena have taken place, low growth, stress on asset quality, difficulty in improving the overall business numbers, how it has impacted the banking industry, which was not impacted to that severe extent in 2008-9, 2009-10, when the entire world believed that there will be a roll-on effect as far as India is concerned, and India would be impacted in terms of financial services sector at least to a very significant extent. Two things which have very majorly impacted, as I mentioned. Number one is the quality of the assets portfolio, the stress on the asset quality portfolio of the banks. Therefore, one of the bigger challenge for the Indian banking industry today is to protect the quality of assets amid the ongoing slowdown, which to my mind is one of the major challenges faced. According to the international rating agency S&P, Indian banking sector is unlikely to recover in the next 18 to 24 months due to low economic growth. It expects the bank's NPL ratio to surge to 3.9% of total loans in FY14 and 4.4% in FY15, compared with a ratio of around 3.4% in FY13, which in itself was significantly higher compared to the lower rates of less than 3% prevailing as far as the system was concerned. S&P also expects restructuring of the assets to remain high in the next 2 years because of the weak economy and the regulatory allowance. High cost of funds, elevated credit cost, and limited opportunities to deploy funds have severely dented Indian banks' industry's profitability. Other major challenges from the medium-term perspective for Indian banks are like this. One, stringent capital adequacy requirement under Basel III. Imperatives of financial inclusion is number 2, and 3, the talent management. These are the 3 more important challenges which the industry need to address to in case we need to come out of these difficulties. According to the RBI guidelines, Indian banks will have to maintain a minimum of 5.5% in common equity, as against 3.6 as of now. by March 31, 2015. This is as per Basel III requirement, slightly more than what the Basel III wants the banking system to maintain. They will have to create a capital conservation buffer consisting of common equity of 2.5% by 31st March 2018. They will have to maintain a minimum capital adequacy ratio of 11.5% against the current 9% by March 31st, 2018. Under the assumptions of 20% credit growth and maybe 22% growth of the risk-weighted assets, from now till 2021, the capital requirement of Indian banking system is well over almost about 9,600 billion rupees for this period. So far as the progress on financial inclusion front is concerned, the achievements so far have not been very satisfactory, as evidenced by the World Bank Findex Survey 2012, which states that only 35% of the Indian adults had access to a formal bank account and 8% borrowed formally in the last 12 months. These minuscule numbers suggest a crying need for a further push to the financial inclusion agenda by the banks in the coming years. In pursuing this mission, the normal banking model has been found wanting in terms of cost efficiency, scalability, convenience, reliability, flexibility, and continuity. Finally, the leadership issue and the right talent would be a key differentiator for the Indian banks in the coming years as they work towards achieving their aspirations for growth with quality and face increased risks of competition from the new domestic banks as well as foreign banks. This is especially critical for the Indian PSBs, that is public sector banks, government-owned, that are currently suffering a huge HR gap in the middle management level. Against this backdrop of the challenges, the relevant question which is being faced by the industry today is how to improve the bank's competitiveness, financial position, and increase their resilience as far as the present turmoil is concerned. So let me therefore try to enunciate a few parameters which perhaps could be addressed to overcome many of these challenges, because if you look back the last maybe almost about 30 years, ever since the new norms were introduced post Narasimhan Committee recommendations in 1991-92, we have seen that India has passed through many cycles of ups and downs, upheavals, but every time the Indian system, the financial system, banks in particular, have been able to overcome these difficulties with a lot of strength as they move forward. Therefore, I would still say that I'm not painting a very pessimistic picture as far as the overall scenario is concerned, but then what is required today is to see that a concerted effort is taken by the regulator and by the government, which is the owner of 70% of the Indian banking industry, because the public sector banks put together almost have a 70% market share in terms of deposits and advances. Therefore, a concerted effort taken together by the regulator and the owner perhaps should ensure that we are able to pass through these difficult, turbulent times, notwithstanding what's happening either within the country or maybe in the external market as far as the Indian context is concerned. First of all, the strategic vision and business model of banks need to be made compatible with the changed economic scenario. For instance, again in the Indian context, I would say corporate credit quality having been under stress, at least for the last couple of years, on account of weak business environment, compression of profitability margins, and pressure on cash flows, forex exposures, project delays, and high leveraging of some corporate groups. While there have been certain positive steps towards resolving some of the structural issues in the power sector, and also greater emphasis on deleveraging by some of the corporate groups by maybe monetizing some of the assets which they own and which they have set up, more steps are required to be taken. Given this, a significant correction in the near term appears to be highly unlikely. This means a need for the Indian banks to reorient their business more in favor of agriculture and retail sectors where stress are relatively lower at this point in time. Therefore, in the current difficult phase, banks should plan their loan book expansion extremely carefully through a product or a market or both. This means banks need to examine whether they have appropriate products or services that suit their customers during uncertain, turbulent times. At any cost, they should avoid any kind of ad hoc expansion without a proper examination of customer analytics and or geographies. Moreover, they need to identify areas where they can reduce cost. Again, the operational efficiency which I was talking about. They might eliminate perhaps business lines that are no longer profitable, even if these are legacy businesses. In fact, bad times offer good opportunities, sometimes to ensure that some of the legacy businesses which are non-viable can be removed out of the portfolio. As I mentioned, present turmoil is characterized by high inflation and elevated interest rates. So it has brought with it an all-round escalation in cost. Hence, a dedicated attention has to be paid by banks for reducing the operational expenses by effectively leveraging existing technological and other infrastructural competencies, including human resources. For example, consumers' increasing preference for self-service through digital channels offers banks a chance to radically reduce their distribution cost. Also, banks should see to it that their labor costs remain in sync with shareholder returns. This may not be immediately possible for the Indian public sector banks due to stricter regulations in terms of the labor, but then other ownership groups can easily try for this. Post-global financial crisis, the other major challenge faced by the global banks in general and in Indian banks in particular is that of a regulatory backlash. Tougher new capital regulations are increasing equity requirements and limiting the ability of banks to leverage their balance sheets. New liquidity ratios are constraining lending activity in some markets, while tougher funding ratios are changing the way banks manage their assets and liabilities. The compliance burden and the costs have increased significantly for all the banks globally. In such changed environment, risk weighting and liquidity absorption rates need to be measured for each banking product and provided to every operational unit to gauge the underlying health of its lending activities. During the times of heightened uncertainty, the bank's top management should adopt a more top-down approach to managing both their capital and liquidity. Instead of unleashing operational units to maximize their own returns, often at great risk to overall institution, the bank leaders need to shape and constrain business unit strategies according to the overall needs of the organization as a whole. The bank CEOs must try to improve their organization's capacity and capability to make decisions. A more robust and transparent approach to decision making with defined decision roles, responsibilities, and processes will become a source of competitive advantage by enabling faster and better decisions and also their execution. To tackle the asset quality issues, there has to be a higher involvement of the bank's board of directors in asset quality concerns and solutions. Banks have to create systems on a war footing for proactive identification of problematic loans. There has to be a close oversight of identified problem loans by the bank's top management. If need arises, banks should also install external loan review system to strengthen the quality of their loan appraisals. Moreover, banks' board of directors and top management should develop strategies for fast disposition of problematic assets. Also, banks need to put in place proper recovery staff, policies, and procedures in place to ensure that these issues are addressed properly in the front end. From the perspective of stakeholder relations, it's a must to keep all lines of communication open, especially during turbulent times. Bank CEOs have to ensure that all the stakeholders are updated on all its financial standing and strategic vision. They need to establish a surveillance and response mechanism to detect and react to any negative news on their business. It is said that it takes many good deals to build a good reputation, but only one bad one to lose it. So, management of reputation risk is extremely critical during turbulent times. Moreover, banks should realize that maintaining the confidence of investors and depositors could secure routine operational funding for their business. Finally, to keep the banks resilient in turmoil, it is essential that the responsibility of the bank's board of directors is adequately understood. In order to meet their obligations and assure the institution thrives, directors must play a much more active role in making sure all aspects of the bank are being reviewed, monitored, and addressed. The board must ensure that the bank is well capitalized. It has good relations with its regulators, is being run well by the management, demonstrate positive financial results for the shareholders, and is ready with a plan of consolidation in order to maximize shareholder value and remain competitive amid turmoil. The entire world thought India would fail. Everybody thought the Indian financial system would fail. Two things. One is the Indian financial system showed its resilience, and number two, within that, many of the banks which were proactive were able to really gather lots of strength in terms of improving the business, picking up the opportunities. Therefore, some of the Indian banks at that point in time, and Bank of Baroda, where I was there, took the opportunity of spreading their business across the international market very strongly, because the banks across the globe were very shy of lending, and therefore were trying to meet their, keep their liquidity rather than lending. It was a cherry picking available for the Indian banks to go and scout for good, large corporate blue chip companies, and therefore many of the banks which were awakened to this particular opportunity did extremely well. Therefore, 2008-9 presented to these banks a ray of hope and opportunity to do substantially better than what they could have done otherwise if the financial system across the globe was not doing well. So that is what is meant by seizing the opportunity in turbulent and difficult times. All of us are in the financial system. Therefore, many of us would have gone through these cycles of ups and downs during the last many, many years. But then every time we have been able to, gain the momentum, bounce back and see that we do well. Therefore, in the current context, when we say that we are in difficult, turbulent times, I would still say that it's a time where we try to reorient our strategies. It's a time when we try to change our style of working. We try to become more positive in terms of our systems and procedures. We try to ensure that the entire outlook in terms of reducing the operational efficiency, improving the operational efficiency, reducing the cost is appropriately put in place. The only thing is, in such a difficult difficult condition, the banks or the institutions which are more proactive in terms of reacting on a proactive basis would certainly do well than others which are also going along as the wind blows, as they say. So, to say that we are passing through difficult times, there is no doubt on that. The general perception is that these pains in the system will continue, maybe for the next 14 to 18 months. So how we will be able to continue to navigate well during these turbulent times, face the challenges, put the house in order, try to bring in changes which could be of immense help as we move forward, and try to see that we seize opportunities in difficult times. I think that distinguishes between the better run organizations and not so well run organizations. Being in the system in India, in the financial circles for so much of a time, I still would feel that the Indian financial system is strong enough, resilient enough, would try to understand these difficult times and come up very strongly in the days to come. The ultimate mantra for survival and resilience during turmoil is, when the going gets tough, the tough gets going, and I feel that Indian banking system has demonstrated in the past its resilience, and going further, it would continue to demonstrate very strongly as far as its resilience is concerned. Now, therefore, in the given context, I think what we are facing in India is not too different than the other parts of the world. For everybody, therefore, this is an opportunity wherein we can set out the house in order and try to see that we face the challenges much more strongly and come out very successfully. When we see the green shoots, when we see that the economy turns better, when economy bounces back, so that we are in readiness to pick up the fruits at that point in time. So these are some of the thoughts I thought that I will share it with you, and maybe I would be happy to, respond to any observations or any questions that the audience may have at this point in time.